DSCR, Debt Service Coverage Ratio, also known as investor cash flow. Here's how it works. Focus on the rental income, the income that the property produces on a monthly basis. As long as that income is more than the mortgage payment, that would be the ratio that you would consider. For instance, if a property has a rental income of $2,000 a month, and then it has a mortgage payment of $1,600 a month, that would be a ratio, a debt service coverage ratio of 1.25. The higher the ratio, the more cash flow for the investor. Typically, we're looking for properties that would have a 1.15 ratio or higher. Most investors are looking along those lines. We will go down to a 1.0 debt service coverage ratio, meaning that if your monthly mortgage payment was $2,000 and your rent was $2,000, that's a 1.0 DSCR. We do not require tax returns. We do not require pay stubs. We do not require W-2s, fixed income award letters like Social Security or a pension, no income documentation. The application wouldn't even have an employment or any type of income listed on the application. The documentation we would need is any mortgage statements of any properties you have mortgaged. If you have a property that does not have a mortgage, we would need the home insurance declaration page to show that there is no lien holder. We would need your ID, and then we would need assets. The assets would consist of your cash to close, which would be your down payment and your closing costs and prepays, plus reserves. These type of loans typically have a 6-month requirement for reserves, meaning if you had a $2,000 monthly mortgage payment, we needed 6 months reserves, that would be $12,000. 2,000 times 6 is 12. So whatever your cash to close is, you would add 12,000 to that, and those would be the assets that we need to verify. The reserves do not have to be in an account that your cash is coming from for closing. It can be an investment account. It can be in several other type of liquid asset accounts. Interest rates. Interest rates are determined by 3 main factors. The first factor is that ratio that we were talking about, the DSCR. The higher the DSCR, the higher the ratio, the better interest rate. The second factor is your credit score. The higher your credit score, the better your interest rate. And then the third factor would be your down payment. The more you put down, the better your interest rate. Timelines. Most of these loans should close between 15 and 30 days. Without the typical traditional financing of verifying income and getting verifications of employment from employers, looking at tax returns, analyzing all that, these loans have a quick turnaround time. They're not your typical commercial loan that could take up to 75 days to close. LLC. These loans can close in an LLC. It can be a single member LLC or multiple member LLC. It's just whoever has ownership of the LLC, whatever members are on the LLC, would need to be on the loan. This is my favorite loan. If you have any questions at all, please do not hesitate to contact me. I am here to help.